Hey everyone, welcome back to the deep dive. We're diving into something today that's, well, kind of foundational to the startup world. Like you always hear about it.
Oh, yeah, for sure. It's one of those things you kind of just take for granted.
Exactly, that 4-year vesting schedule for founders. It's like almost automatic, right? But we're gonna question that today and see if it really still makes sense.
Yeah, it's so ingrained, isn't it? Like it's just the way it is. But the thing is, when you actually start digging into like where it came from
Yeah.
and the whole landscape of startups now, it gets really interesting.
Totally. I mean, we've been going through some really insightful stuff, a mix of like historical context, like how did this 4-year thing even become a thing?
Right.
And then some pretty crazy data on how long it actually takes startups these days to actually exit.
Yeah, it's completely different to how it used to be.
Completely different. So our mission today is to, I guess, figure out like why did this 4-year vesting become the standard? Does it still hold up given how the whole world of startups has changed?
Mhm.
And then what are maybe some smarter ways to think about founder equity?
Yeah, absolutely.
So to pick things off, I think it would be cool to go back in time a little bit. Like, how did this 4-year standard even come to be?
So it's actually kind of funny. It wasn't like some big revelation or anything. It's more of like a historical accident almost.
Really? So not like some VC guru came down from the mountain and was like, "This is the way."
No, not quite. It actually goes back to, believe it or not, the Tax Reform Act of 1986.
Oh, okay. I'm already getting flashbacks to like econ class.
I know, right? Not the most exciting topic, but stick with me. There's a point to this.
Okay. I trust you.
So basically, this act put limits on how long it could take for like employer contributions to pensions, to fully vest, and that was somewhere between like 5 and 7 years.
So not directly about startups then?
Not directly, no, but it kind of set a precedent. Like it gave people an idea of what a reasonable vesting period might look like.
Okay, I see. So like a kind of a starting point.
Exactly.
Right.
But the real turning point, the thing that really cemented the 4-year vesting, was the dotcom boom, back in the 90s, early 2000s.
Oh yeah, the Wild West of the internet.
Exactly.
Yeah.
And back then, the time it took for a startup to go public, to have an IPO, was way shorter. Like we're talking 4 to 5 years on average.
Whoa, really? That's crazy fast compared to today.
Right. It was a completely different world.
So startups were looking at these like super quick exits and thinking, okay, we need our founders to be fully vested by then.
Exactly. They wanted everyone on the same page, everyone incentivized to reach that IPO finish line together.
Yeah.
So offering a 4-year vesting schedule became like a competitive advantage.
Like, come work for us. You'll be rich in 4 years.
Pretty much. It was a sign of commitment, a sign that everyone was aligned on this super fast growth trajectory. And that mindset, it just stuck. It became the default, even as the startup landscape changed dramatically.
Right. Which brings us to the present day. And this is where things get really interesting. Because that VentureBeat article we were looking at paints a very different picture, doesn't it?
It does. It really highlights how much things have changed. Back
Yeah.
in 2017, their data showed that the median time to exit, whether it's an acquisition or an IPO, had jumped to 8.2 years.
8.2. That's more than double the time frame that kind of birthed this 4-year vesting standard.
Yeah, it's a huge difference.
So the big question is, does this 4-year vesting schedule even make sense anymore? If it was designed for these like quick exits and now exits are taking way longer.
Right. It really makes you think. The whole point of vesting is to keep founders motivated, to keep them aligned with the company's goals. But if there's no big payoff in sight for 8 years or more, does that 4-year mark really have the same impact?
Yeah, you would think that with these longer timelines, you'd want even more alignment, not less.
Absolutely. And the article points out this interesting trend where a lot of startups are actually choosing to stay private for longer.
Yeah, they're raising more funding rounds, extending their runway, not rushing to go public or get acquired.
Exactly. And they even mentioned some pretty big names that were doing this back then in 2017.
Yeah.
BuzzFeed, Hers, Qualtrics, WeWork, Ola, Airbnb.
Big players, yeah.
And this has a ripple effect, right?
Mhm.
Because venture capitalists are pouring money into these late-stage private companies, so their capital is tied up for much longer.
Which means it takes longer for them to give returns back to their investors, the limited partners.
Exactly. And that creates this whole chain reaction of illiquidity.
The LPs are waiting longer, which impacts how quickly they can reinvest in new funds. And the article even questions whether the traditional VC fund life cycle even works anymore with these longer timelines. Like, the whole system was kind of built around the idea of quicker exits.
Yeah, the assumptions are being challenged. It's forcing everyone to rethink how things work.
But it's not like the industry is just ignoring this shift, right? Like, we saw some examples of how things are evolving to adapt.
Right, right. So one big one is secondary sales. This allows founders and early employees to sell some of their vested shares to investors before the company fully exits.
So they can actually get some liquidity, some actual cash, even if the IPO or acquisition is still years away.
Exactly. It helps to balance things out a bit. You're not just sitting on this pile of stock that's worthless until who knows when.
And then there's accelerated vesting, right?
Yeah, that's becoming more common too. So basically, if certain events happen, like an acquisition, the vesting schedule speeds up. So you might get a bigger chunk of your equity sooner than you originally planned.
It's like a way to deal with the uncertainty of when the exit might actually happen. But, one of the sources we looked at actually made a pretty interesting point about employees. Like, maybe 4-year vesting still makes sense for them.
Yeah, that's a good point. Like for employees, a 4-year vesting schedule is still a pretty strong incentive to stay with the company, to contribute and to see their equity grow.
And their commitment's different from the founders, right? Founders are in it from day one for the long haul.
Exactly. So maybe a one-size-fits-all approach isn't the best way to go.
Yeah, like maybe we should be thinking about more like customized vesting schedules based on, I don't know, your role in the company, how much equity you have.
Right. Like maybe founders who are taking on the most risk should have a longer vesting period, maybe even 8 years.
Wow, 8 years, that's a long time.
It is. But it reflects the level of commitment they're making. And then like key early employees could have something in between, maybe 6 years, and later stage employees could stick with the traditional 4 years.
So it's about like matching the vesting period to the level of impact you're having on the company and how long you're likely to be there.
Yeah, it just seems more and more thoughtful than just blindly following this old standard.
Right. Because at the end of the day, this 4-year thing, it wasn't based on some like fundamental truth about startups.
Right.
It was just a product of its time.
Exactly. Like one of the sources even said it's kind of silly to just stick with it now, given how much the world has changed.
It's what they call the lazy use of averages, right?
Yeah, yeah. Like we've taken this average exit time from way back when and just assumed it still applies today.
And the best founders and investors, they don't do that, right? They actually think critically about what makes sense for their specific situation.
Exactly. It's about first principles thinking. It's about understanding the underlying dynamics, not just blindly following the old playbook.
So for you listening, whether you're a founder, an investor, an employee, the key takeaway here is don't just assume that 4-year vesting is the only way to go. It's a relic from a different era.
Yeah, times have changed. Exits take longer. And while things like secondary sales and accelerated vesting can help, it's worth really questioning whether this 4-year standard is still the most effective way to keep everyone motivated and aligned. I've even heard founders talk about how they felt a bit lost after their 4 years vested, even though the company was still growing, still years away from an exit.
Interesting. It's like they hit this milestone, but then the big goal is still so far away.
Exactly. And that can be tough, to maintain that same level of drive when the finish line keeps moving further away.
So bottom line, the 4-year vesting schedule, it's not this sacred rule. It's something that we should be questioning and maybe even rethinking altogether. Now you understand where it came from, why it might not be the best fit for today's world.
And that brings us to a final thought for you to ponder. Given everything we've talked about, what principles should actually guide vesting decisions? Like what factors should we be considering beyond just this old average exit time? What really matters for keeping founders engaged and committed for the long haul?
Yeah, it's a good question to ask yourself because the answer might surprise you. Thanks for joining us on the Deep Dive. We'll see you next time.
See ya.